Hello and welcome to the weekly Forex Outlook at XM.com. Next week, the spotlight will be on U.S. jobs data. We'll also get the Bank of Canada's decision and GDP data out of Australia, which may impact the Aussie's rally. I'm Maria Pachordis, and joining me is Senior Investment Analyst Harlem Bisuros. So Harlem, let's begin in the U.S., where investors are eagerly awaiting the non-farm payrolls results due out on Friday. Now, back in July, we got weaker than expected numbers. What are we expecting this time? What will the data mean for the Fed's rate path? And what reaction might we see in the markets?
Hello, Maria. Yes, back in July, we got weaker than expected employment data, and who can forget the market reaction? The numbers triggered a wave of turbulence, raising fears about a potential recession in the US, and prompting investors to price in aggressive rate cuts by the end of the year. Now, although subsequent data eased somewhat those fears, and thereby investors scaled back some of their bets, the dovish speech by Fed Chair Powell at Jackson Hole did not allow them to materially change their view. Just to give an idea, investors are now seeing a decent 35% chance for a 50 basis points rate cut in September, and they are penciling in a total of 100 basis points worth of reductions by the end of the year. Now, at Jackson Hole, Powell highlighted the importance of the labor market, and thus Friday's data will likely be the main event of the week. So, if we do see further cooling in the labor market, this may convince more traders that the Fed may start its easing cycle with a bold 50 basis points reduction. In other words, the probability for a double rate cut in September will increase, and this could push Treasury yields lower and thereby add more pressure on the US dollar. Now, the question is, how will equities react? For example, will another weak employment report revive recession fears, or will investors cheer the prospect of even lower borrowing costs? I believe that the answer lies on the outcome of the ISM manufacturing and non-manufacturing PMIs for August, due on Tuesday and Thursday. If the ISM prints suggests that the economy is faring pretty well, pointing to improving business activity, investors may maintain confidence in the US economy, and thereby when we get the jobs data, even if they come out on the weak side, equity traders may decide to increase their risk exposure, buy more equities on the prospect of lower borrowing costs.
Moving over to Canada now, we'll get the BOC's interest rate decision on Tuesday. At its July meeting, the BOC announced its second cut in a row. What data has come out since then, and how might that affect the bank's upcoming decision and the Loonie?
The Bank of Canada announced its second straight cut last time, and the market participants are nearly certain that we will get the third consecutive reduction next week. There is even a 15% chance of a double 50 basis points cut. Now, since the July meeting, the monthly GDP data revealed that the Canadian economy slowed in May from April and approached stagnation in June. The employment report revealed a greater loss of jobs in July compared to June. And what's most important is that inflation continued its downward trajectory. We had further slowdown in inflation according to the July data. Now, all this supports the case that the bank will cut again at this meeting, and it also suggests that policymakers will maintain a very dovish stance. So the Loonie may slide in such a case, but considering that rate cuts have already been anticipated for each of the remaining meetings of the year, the broader outlook of dollar Loonie is unlikely to change much. Due to its risk-sensitive nature, the Loonie has recently been enjoying flows as risk appetite remained elevated in the face of aggressive Fed rate cut bets. And if the US data we already mentioned corroborate the view of aggressive rate cuts by the Fed, I believe that the prevailing downtrend in dollar loonie may stay intact.
And finally, in Australia, we'll get GDP data for the second quarter on Wednesday, as well as manufacturing and services PMI data out of China on Monday and Wednesday. What are we expecting there, and what reaction might we see in the Aussie?
Now, when they last met, RBA policymakers decided to keep interest rates unchanged at 4.10%, and they added that they remain willing to further tighten policy as inflation, although it is declining, remains elevated. So this makes the RBA, puts the RBA at a different basket than other major central banks. The RBA sounds more hawkish than other major central banks, but yet the market is not penciling any additional rate hikes by the RBA. On the contrary, traders are almost fully pricing in a 25 basis points reduction by the end of the year. And if we do get soft GDP data, and also Chinese PMIs, the Caijin PMIs pointing to some softness, then investors will become more convinced that yes, the RBA may at some point decide to signal rate cuts before the end of the year. If this is the case, the Aussie could give back a portion of its latest aggressive gains, but the fact that the RBA is still expected to cut by, or let's say the RBA is seen way less dovish than other major central banks. And also taking this, combining it with the broader risk appetite, I believe that all these variables may keep any GDP-related losses limited and short-lived. In other words, we have the Aussie in a steep uptrend. We may get a correction if we get soft data next week, but the broader outlook is unlikely to change.
All right, Lomas, thanks so much. This was the weekly Forex Outlook here at XM.com.